I'll start with a few individual stocks because some of these falls are truly shocking. Rio Tinto 6%, BHP 5%, Macquarie Group more than 7%, One Steel 7%, David Jones 5.7%. It's easily the worst carnage since October 2008, just after the credit crisis reached its climax with the collapse of investment bank Lehman Brothers. The All Ordinaries Index closed 4.2% lower at 4,169, which is its lowest point since July 2009, when it was halfway through climbing out of the 2008 crash. Energy, mining and small caps did the worst, and the index futures contract is currently betting on a further fall of 4.5%. It's best to look at the bond market to get a sense of what's happening and why. It's mainly fear over Italy and Spain. The yields on their 10-year government bonds, which are the debt securities that governments sell to borrow money, have soared because their prices are collapsing. This is the epicentre of the new crisis. By raising the interest rate that Italy and Spain have to pay on their borrowings, bond traders are making a crisis more likely. Across the Atlantic, the yield on US government bonds has gone dramatically in the other direction. But that doesn't mean it's good. It means the bond market is anticipating a recession. But at least there's no problem for the government in borrowing money cheaply. The problem there is getting Congress to let it borrow. The average fall in Europe was 3.5%, but the Italian market dropped more than 5%. Wall Street fell 4.8%, Japan 3.7%, and the Chinese market got off relatively lightly. Commodities were also hit hard, except for gold, which, as you'd expect, saw some safe haven buying. And the Australian dollar is trading at 104.5 US cents, down 2% on where it was this time last night. I'll be back at 10 a.m. on Sunday with Inside Business and a full rundown of what happens tonight and why.